I'm the General Manager of LuxFLAG. On behalf of LuxFLAG, I'm very pleased to welcome you for this third webinar this morning on SFDR in the spotlight. Sustainable finance has become at the center stage of this or the financial industry for last over a year or so, and within that, of course, SFDR has been very much discussed. As the sustainable finance grow, of course, importance for transparency initiatives such as LuxFLAG labels also grows. LuxFLAG witnessed about 75% growth in the last 12 months. In addition to our activity, which is around raising awareness and sharing expertise of around sustainable finance topics, which we do under our second, initiative, which is Associate Membership Program. These type of webinars are organized in partnership with our associate members, and GSK being one of the partner, they will be hosting the session today. So for the session, before going to introduce the session, I will just provide some logistical details. All the session recordings would be made available to the audience via email very shortly. You can always ask questions, which are very welcome, by using the chat box, which you see at the right bottom corner of your screen. Please keep yourself muted if you're not speaking as speakers, so that there is no disturbance. And of course, more interactive session with audience participation would be, of course, helpful. So thank you very much, GSK, for attending, for organizing this session, and I will hand over now to Irina Stadiarova to take over.
Thank you. Ladies and gentlemen, good morning and welcome to our webinar organized in partnership with LuxFLAG. In a nutshell, GSK Stockmann is a leading independent corporate law firm with a strong focus on ESG matters, apart from its other areas of expertise. And I'm a senior associate in our investment funds and private equity department, working in Luxembourg for around 8 years and advising national and international clients on all legal and regulatory aspects in the fields of investment funds, UCITS, IFs, different types of unregulated structures, private equity, corporate, as well as M&A matters. In the last 2 years, I developed my expertise and knowledge also in ESG-related matters and driving the ESG initiative within the firm. Now also advising the asset managers, not only in relation to general regulatory matters, but also in relation to sustainability aspects. The topic of our today's webinar is the SFDR, or disclosure regulation, whether the asset managers ready for the 10th March 2021. Today, we are going to share with you the challenges the asset managers are facing with view to SFDR implementation. And we'll try to provide you some practical guidance on how to best handle the topic. At the end, we will have also a Q&A session, so don't hesitate to ask your questions, and we'll try to answer where possible. So I'm joined today with 2 representatives from asset management side, Antonio Thomas and Marco Cipolla. Antonio, Marco, I'll let you introduce yourselves. Please go ahead.
Hello, I'm Antonio. I represent Limestone Platform, which is a cross-border third-party man code. It's been here in Luxembourg since about 2007. And we run both standalone and hosted solutions. I have 30 years in the industry, about half of that as a portfolio manager, and more recently, the last 15 years or so in the management company space.
Thanks, Antonio. Marco Cipolla, Managing Director of a selection management company. 15 years of experience in the industry, and just discovered that I landed here in Luxembourg the same year as Antonio. And I've been working for a selection management company since its incorporation back in 2013, and Selectra is providing third-party management company services for both UCITS and alternative funds in different asset classes, including also impact investing and sustainable finance funds. Therefore, also the importance of this topic and the upcoming deadline on the 10th of March.
Thank you, Marco. Thank you, Antonio. So the road to the 10th of March, where do we actually stand now? So by 10th of March, the financial market participants, which of course includes AFMs and the UCITS management companies, will have to comply with a high-level principle-based requirements under the regulation. Even though level 2 measures were delayed. However, it was confirmed that SFDR is not conditional on the formal adoption and entry into the forms of the regulatory technical standards known as RTS. So there is only 5 weeks left to finalize actions required under the regulation. In particular, swiftly to assess and categorize all the products, either to categorize as Article 6, more known as neutral, non-ESG product, or light green or dark green products, as defined under Article 8 and 9, and also implement the necessary amendments into the policies and process to be published on the websites of the entities, so AFMs and MENCOs, and also in the pre-contractual documents of the funds. Good news that ALFI yesterday presented the new guidelines on the sustainability-related pre-contractual disclosures. So it seems that now we have more clarification on certain topics, even though some questions still remain to be clarified and confirmed at EU. Another good news for the industry is, and the Luxembourg Business Center, is that last Friday, credit rating agency Moody's has certified Luxembourg's good environmental, social, and governance, so ESG performance with AAA rating for the first time ever. So it's clear enough that climate change will be the defining factor in the company's long-term prospects. And we are on the edge of the fundamental shaping of finance. Big large IT companies such as Apple, Microsoft, and Amazon announced their commitment to become carbon neutral by 2030. As eventually, it's not an investment if we're destroying the planet. But in the end, in order to be ESG and sustainable compliant, some work still needs to be done. And we will discuss the challenges linked to the implementation of the disclosure regulation. So Marco, Antonio, you are both representatives from the AFMs and third-party AFMs and UCITS management companies. So offering hosting solutions, and as such, have to comply with a number of mandatory disclosures required under SFDR. What is the most challenging in terms of implementation of the SFDR into the firm's business practice, for example? And how are you dealing with those challenges, considering the upcoming deadline of the 10th of March? Antonio, what are your views on that?
Thanks, Irina. I think the biggest challenge, I guess, and the first place to start, especially if you have hosted solutions, is actually to ensure that you are clear about what your role is in the chain of partners involved in the fund. So in our hosted solution, sometimes we act as the portfolio manager, and the sponsor is the advisor to the fund. Sometimes we delegate the portfolio management to a third party, and so on and so forth. So it's really important, first of all, to agree where you sit in the partner in that chain, and clearly to recognize that where the strategy is being driven by an advisor, that you really need to have them on board with the challenges of how you need to disclose certain things, because clearly their remuneration is driven differently if they're an advisor versus if they're the PM, and so on and so forth. I think the next biggest challenge for us has really been to find a level playing field, because we have managers that are based in Asia, Middle East, who are outside the EU. They're not necessarily up to speed with all of the regulations. We have managers that are faced with Brexit challenges, and indeed, given the UK government's declaration on the 11th of November that they probably wouldn't follow SFDR and the March deadline, and instead they've created this TCFD task force. There's also a challenge to remind those managers that just because they're in the UK, the product itself is regulated in the EU, and therefore they still need to comply, and there's disclosures and so on and so forth. And that brings a different challenge in terms of how they would do that without conflicting in the regime in the UK or the regime here, and so on and so forth. So what we've really had to do is to sit down with each of our clients on a case-by-case basis, set up, if you like, a mini task force, weekly meetings, run through what the agreed deliverables are, and then really start to work down on those work streams about which bits should be done. So where do we need to expand on our RMP? How do we need to broaden out our onboarding processes, due diligence, that kind of stuff? How do we need to change our investment process? How do we document this kind of stuff? Where and on whose website should disclosures and policies be, depending on the roles, as I mentioned before. And so really the challenge is to start that process early enough, post the 16th of December and the fast track process, so that we can capture all the players and deliver that around. And clearly the biggest challenge is making sure that everyone agrees that this client should be Article 6 and this client should be Article 7 or 8 or 9 and so on and so forth. So that's really been something that we've really got to grips with as early on as we could with our own client base in the hosted solutions. For our standalone clients, it's slightly different because they drive the process more than we do. So they engage with their lawyers. They're the ones responsible for updating documentation, PPMs, and so on and so forth. So there we're less in the driving seat, but a similar process in that sense.
Okay, thank you, Antonio. Marco, what are your views on the situation? How are you dealing with all those challenges?
Clearly, as a third-party mentor or AFM, the coordination among all the stakeholders is fundamental. So the first step being taken by us last year, starting contacting all our asset managers or investment advisors, being sole promoters of the fund initiative, and informing them of the coming regulations, and of course of the different implications and deadline for their product. I think that for any third party mentor or AFM, this is the most challenging task because it's not something that stands only on the shoulder of the AFM, but a clear coordination. So with the fund promoter, with the fund governance being the GP or the board of directors of as well as external advisors that these entities might appoint independently, it's key. So on our side, of course, we are going ahead with an internal analysis, also with the support of an advisor in this respect, while the single asset manager decided to appoint their own, especially because falling under the Article 8 of SFDR. On the other side, for our other promoters, we will do this process hand in hand, and of course respecting the deadline. Another challenge, as Antonio was saying, is in relation of also the update of the website innovation policy, which will not only stand on the AFM, but also again with the appointed asset managers that have to take this responsibility. But again, our oversight duties oblige us to ensure that everything is done, and everything is done, of course, within the March deadline. And for what concern the prospectus update within the end of February with the fast track CSSF procedure. If we look also at the difference between the UCITS and the AFM world, of course, we see that on the UCITS side, everything is mostly on track. Also for what concerns the obligation to update the prospectus. On the AFM side, alternative funds, in some cases it's more complicated in implementing the full process, and with some of the ACE, we're not going to update the prospectus, but as a side information into the contractual obligation that will be anyway due to the investor starting March the 10th.
Thank you, Marco. So surely there are still a lot of, let's say, challenges and uncertainties with view to the implementation of SFDR. From our side, for example, since a few months, we are organizing also different seminars and presentations with the clients, assisting them with the implementation of regulatory, of the regulation, and trying to find solutions basically on a case-by-case basis. Because indeed, each product, however, should be analyzed separately and categorized, taking into account its own features. As of now, it seems that most of the clients are taking more, let's say, cautious approach and tend to categorize the products rather under Article 6, so as neutral funds. But I would assume that perhaps once the final version of level 2 measures is published, one may expect that some products would be upgraded to Article 8 or 9. I don't know, in terms of categorization of your products, whether you rather now tending to categorize as Article 6, or if you have already products that potentially could be into the scope of Article 8, which promotes environmental and social characteristics, or Article 9, which basically is an impact product and invest in sustainability strategy. Marco, what is products? Yeah, let's select.
Yeah. On our side, and I think this is common also to the entire industry, most of the products today are Article 6 only. Unfortunately, I would say we have anyway a UCITS product which is also labeled by LuxFLAG, which positions itself as Article 8, and some other promoters which most probably be in the scope of Article 6, but are anyway already exploring the possibility to upgrade at a later stage. And I think that the technical requirements will help in this process also for them to understand in details the measures to be monitored on an ongoing basis and then to adapt their investment policy, and also being the scope of an Article 8 more difficult for an Article 9, because in that case, also the product might be hardly revised, and possibly it will be more for new products coming on the market.
Thank you, Marco. Antonio, what about you? How are you dealing? What is the major part of the product that you have now for the time being?
Well, I'm definitely not sleeping much, I know that. But in terms of my client base, I actually have a client that is captured by Article 7, 8, and 9. And we've already issued a 27th of January PPM, which has about 7 new pages added to it of disclosures, both at the ESG level and the various health warnings, risk warnings, but also some disclosures in the absence of any real guidance, some disclosures around what the third-party manco in question will be doing in terms of the investment process, and so on and so forth. There's some interesting links to the various websites, as I referred to earlier. So there's an additional 14 or 15 page documents on the manager itself with respect to Article 7, and exactly how they run through their process. And there's a lot of technical specs, data, disclosures, and so on and so forth. So, you know, this is actually quite a challenge for the manager themselves and the third-party manco with respect to making sure that everybody's on the same page and they understand all the tools, and the policeman is policing in the right way, and so on and so forth. But it's also incredibly detailed for any investor that comes along and now has to sort of work their way through all of this additional data. And there's clearly new terms like green sheen or greenwashing, and things like that that people have to get to grips with, and different processes. And then if, as in the case of this client, they also market in places like Hong Kong, so they have a Hong Kong version of their PPM as well, there are some additional challenges in terms of terminology and how that's articulated specific to the Hong Kong investors.
Okay, thank you, Antonio. As a third-party AFM, you surely also work with a wide range of promoters and initiators. And I understand that not every promoter that has enough knowledge in relation to the SFDR. Does it potentially create any challenges to you as AFM? And what would be your advice, for example, how to best approach the situation with those promoters and initiators? Antonio, would you like to start?
Sure. Yeah. Well, as I said, we, I was talking at 5 a.m. this morning to one of my managers who's in Singapore, exactly on that point, because they've been approached by the Singaporean regulator with respect to the due diligence that they do. They've been asked to provide certain checklists and certain data. And of course, the easiest thing for them is to then come back to the AIFM in this question and say, look, can you please give us the due diligence that you do on the third party so that we can include that with our response? And of course, we've had to go back to them and say, actually, we're not really allowed to do that. So we have to agree on the best way to respond to your regulator as to why we can't provide that info, because that's really for the AIFM and the board in question of the relevant product. In this case, there's a manager and an advisor, and they're not actually involved in that due diligence process. So question, why does the Singaporean regulator need to see it? What do they expect to see it? And so on and so forth. So in actual fact, what we've been doing with those kind of challenges is organizing separate sessions, which takes a lot of time and effort, but really trying to make tailor-made mini cut-down sessions that basically says, look, here's the fast-track approach. This is how we think it impacts your fund. This is where we think you need to adapt your current reporting, or this is where we think we need to increase certain cycles or add to existing checklists, and so on and so forth. And vis-a-vis marketing material, this is what we think we're going to have to do going forwards in the absence of any guidance about wording and so on and so forth. And if I go back to my UK-based manager who is an ESG manager and has already provided all of these health warnings and risk warnings, already again talking with them last night, we believe they'll have to resubmit another PPM before the 28th of February with additional notification specific to Article 7 and Article 8 and Article 9 about where to find certain documents and so on and so forth, which isn't necessarily as transparent as it might have been. So there's a lot of effort and energy that has to go back into it, and really making sure that everybody's on the same level as to where we are. So I absolutely agree with Marco that I guess the baseline approach, without trying to get a square peg into a round hole, is to try and aim for as many of your clients as possible being in Article 6 and taking if you like, the base case disclosures and formatting, so that in the future you can build up on that and change any disclosures that you need to in the future once further guidance comes out.
Thank you, Antonio. Marco, are those challenges also familiar to you?
Yeah, absolutely. Because actually, not all fund promoters are well aware of what is SFDR and how this impacts their product. Of course, fund managers, which are most closely to sustainable finance, of course, are well aware and also anticipated the implementation of the regulations and the analysis, of course, of their product. But on the other side, there are some others which probably also more mainstream and not considering the impact of sustainable finance on their investment strategy, on which we had to do multiple session, training session, explanation of what SFDR is and how it affects their fund product, the side effect position themselves as a non-sustainable strategy. So that is the main one which has the most of the time. But anyway, everyone that is has been voting and align also on their duties. And for some of them, it's also again an opportunity to reconsider their product, and also from a commercial perspective how this might enhance the distribution of their fund. I'm not saying that these challenges are completely solved, but for sure all of them will meet the first basic requirements for the deadline, and from that point on we can build for the next step, starting with technical requirements.
Thank you, Marco. Just going back to the point that Antonio mentioned, I think you mentioned about the marketing information, marketing documents. It's basically, yeah, it's important to know that it must be really ensured that marketing communications do not contradict with information disclosed according to the SFDR. This should be also be taken into account, and potentially contents of the usage kit or PRIPS kit also should be consistent with the provisions of the pre-contractual documents of the relevant fund. So just something to bear in mind potentially for in terms of different mandatory provisions. And what I understand, and probably can be also one of the challenges in case you have a non-EU delegated portfolio managers acting, for example, for the EU AFMs. The regulation might not be probably applicable directly to them, but it is expected that potentially to apply by way of contracts, whereby the AFMs might want to mirror some provisions applicable to them, to those delegated portfolio managers, where basically the AFMs would ask probably the delegated portfolio managers to comply with those provisions, or at least to some extent, in order to simplify let's say, their mandatory disclosures and work in relation to the SFDR. There are also another set of disclosures that have to be considered and performed at the entity level. As you already mentioned, for example, such as review and potential amendment of the risk management process, remuneration policies, due diligence process. However, what we observe quite often is the perception of the information. It's one thing, but indeed the implementation is another. And a lot of asset managers are struggling now with view to the implementation of the data into the different provisions and policies. What about you, Marco? How are you dealing with the amendments and implementation of different policies at the level of the entity level, for example, as remuneration policies or RMP?
Yeah, of course, despite someone might think that the only burden is to update the prospectus and file it with the fast-track procedure by February the 28th. There's much more to be done. You're remembering as well the KID, the usage kit or the PRIPS kit, as well as other pieces of information at the marketing level. So all the pre-contractual communication to investors before subscribing the product. Of course, it's again a coordination work with the different stakeholders, and of course each asset manager needs to keep in mind that the list of documents that might be impacted is much broader than the simple prospectus or offering document. At the entity level, of course, we have a certain number of procedures, policies to be updated. You mentioned correctly the risk management process, the remuneration policy, and also the disclosure on websites and marketing provisions. We are working in parallel on all of them. The big challenge as a third-party mentor is also to align on the different products because the different projects and discussion open with clients and it's a continued job which will be closed only when the very last client will the analysis related to him will be finalized. We are on all of them and again quite confident in closing within the deadline. Something not to be forgotten. It's also then the technical implementation. For example, for disclosures on website, because on our side, for example, we're also working on that. But not to forget also the technical time frame then for webmasters to update the website and publish the information, as well as for the clients which have a dedicated website for that fund.
Thank you, Marco. Antonio, same question to you.
Well, I think one of the sort of the biggest issues for us is ensuring that we've got access to the data. And where it's a hosted solution that we control, that's easy to do. You know, it's our website, it's our PPM, they're our policies, it's our investment committee. And clearly we can set the criteria of what data is required, who needs to provide it, what frequency, how that's shared, and so on and so forth. I think in the third-party standalone space, it's much more challenging because, you know, we have to then periodically now put in place monitoring where we go to the portfolio manager's website and check that documentation there and it's up to date and the disclosures are there and so on and so forth. And likewise, with respect to the updates of the RMPs and the technical data there, we also have to make sure that our risk team actually can interpret the data and follow it and make sure that actually the approach is the same. And that's different. I mean, we cover private equity, real estate, liquid assets, and so on and so forth. And so you have to make sure that your risk team and your RMPs are taking the right approach at the AFIM and UCITS Manco level. And so again, that comes back to those training sessions and agreeing a new set of criteria, a new set of early warnings, if you like, or how to set up and how much notice people need if you're going to buy a new investment, what additional EPM assessments are required, what additional data is required if you're doing real estate and there are its development, or if it's residential, and so on and so forth. So there's all of those kind of things, and there's only so much, especially if it's a third-party fund and it's a participation in a real estate asset, for example. There's only so much that you can drive the process by saying to that manager, you have to insist that in your contract with the SPV, these boxes are ticked and these items are covered. And not all managers will understand that actually if the underlying target asset refuses to do that, potentially the investment committee or the board of the fund will have to say that's not an eligible investment anymore. So there's all those kind of things that we have to work through. I think it's early days yet, so there's no sort of people trying to impose rules, but I think it's important to be aware that these bumps are in the road and that they need to be worked around. And then I think the next bit, which is the bit that lots of people forget because we're so focused on the investment side, is distribution and sub-distribution and platform distribution. And really the obligations that we need to put in those delegated contracts, whereby a sub-distributor also now makes sure that they're positioning the fund in the right way. If there's a technical description, they have to explain it the right way. Do we need to amend application forms now to include specific disclosures? If we're dealing with seed investors, I mean, I had a case recently where a large German insurance company agreed to seed an investment product with 100 million euros, but that came with a whole raft of ESG and sustainable finance requirements, which was so, which had such an impact on that product that in the end, what the manager had to do was create a specific share class for that investor just to secure the seed money. and then create another sub-fund for other investors that come in that will have less investment rules. So these are all things that we have to sort of work through and anticipate now in terms of onboarding clients, launching funds, and basically what we do on a day-to-day basis.
Thank you, Antonio. So just a couple of points to pick up. So where we get with this now is that you have your website disclosures. And for example, in terms of integration of sustainability risks, Article 3, it's clear that there is no single approach. So it depends largely on the strategy. Every asset manager needs to disclose how you deal with sustainability risks and how you consider those risks, in addition to all other risks that you already consider in any way, for example, such as credit risk, counterparty risk, and the like.
Yeah.
So eventually you have to take into account the specifics of your strategy, geographical area, and you have to come up with a policy. As, for example, the real estate manager may have to consider different sustainability risks than the manager investing in private equity. So obviously, each firm will do it in a different ways, but important to bear in mind that the deadline for this is 10th of March 21. So still a couple of weeks to finalize the policies. So for another topic, it would be interesting to share the approach from the different regulators. So we are all aware what's happening in Luxembourg, that CSSF opened the fast-track procedure so that prospectuses and issuing documents of the funds could be amended and visa stamped via simplified procedure. And yesterday, they even clarified via another webinar on some specific matters, for example, in terms of material changes, what could be potentially considered as material or not, and would be into the scope of the fast-track procedure and what is out. But for example, what's happening? Yeah, basically, Antonio, I think you have the offices also in Estonia, and it would be interesting to see what's the approach that the Estonian regulator is taking in that regard.
Well, I guess this is where we talk about proportionality. You can't really compare Luxembourg and Estonia in terms of fund volume and scope, but most certainly in Estonia, they are, let's say, slightly more understanding and a bit more relaxed with respect to their local market participants. So they've clearly issued statements saying that everyone who's in scope must be compliant by the 10th of March. And they must comply with the level 1 principles and then have all the relevant notices, disclosures, pre-contractual documents, and so on and so forth in place. However, they have not made it a prerequisite in terms of their agenda of things to do in 2021, that they will basically be taking any action, on-site visits, independent checks with those managers. Rather, they've implied a two-step compliance approach. So first of all, make sure that you're fully compliant with disclosures as per 10th of March. And then secondly, to ensure that you go back and revisit those disclosures, your processes, and so on and so forth, so that you're fully compliant by January 22nd, or any other such deadline that might come out in the meantime. And in some ways, it's a bit like the UK, who, and we heard from an earlier panel about that. Clearly, UK managers have many things on their plate to deal with that are Brexit related, but equally, in some ways, they have to have a two-track process, if you like, one that covers their UK requirements and their UK investors, and then secondly, one that deals with any asset gathering, any investors that they're trying to seek that's out width of the UK and clearly within the European Union. So I think, there's two examples there where regulators are taking slightly less defined and less deadline-driven approaches. But you can, from my point of view, it makes complete sense and indeed provides certainty and comfort to investors investing in Luxembourg funds that the CSF has set specific deadlines and has given specific requirements, because clearly this is a much more active market.
Thank you, Antonio. It seems also that it's crucial to involve in the other stakeholders, for example, in the SFDR disclosure process, such as board members, for example, of the funds, who are responsible for the fund documentation. Awareness should be ensured on different levels. And what are your views on that? Marco, do you want to say something?
Yeah, as I mentioned also at the beginning of this panel, it's not only at the level of the management company or the firm. There's a lot of other players involved in this process, and the role of the board of directors of the fund, of the general partner representing it, it's key also because once all the analysis being performed and the impact on the different pieces of regulation, legal documentation, etc., has been completed by the AFIM, also together with the fund promoter, the dedicated asset manager. The approval from the board of directors, when it also comes to a review of the prospectus or the uses of RIPSKID, it's something to be taken into consideration, and also considering the short deadline to be scheduled in a proper manner, also for the purpose of the fast track procedure with the CSSF, with either board meetings or at least super board resolution to be organized within the deadline, and also anyway to have the support from the fund governance in this process and their intervention or advice where it is the case, because they also have a clear responsibility as the management company or a firm in the process. So again, it's not a single player game. It's a team game, and the role of the management company is pivotal, as it is often the case in coordinating all the parties involved and also to keep everyone on track, because there are clearly oversight responsibilities on the management company towards ultimately the investors, which are also the target and should benefit from this implementation of the regulation.
Indeed, thank you. Yeah, it should be a big team which helps with the implementation of SFDR. Antonio, what are your views on that?
Well, I think it's really important to view the whole thing as a pyramid. So you really have to start at the board and work your way down. Most certainly, that's what the investors in those products will be doing. So the boards that I'm linked with, we spent quite a lot of time getting to grips with the SFDR process, the fast track process, each of the relevant strategies involved, inviting the managers or the advisors to the relevant board meetings just to give us an update with their business plans, where they intend to go, making sure that the AFIM can do the things that it has to do. But it's also important that the board is kept up to speed for a different reason, which is it's audit season right now. And as we found last year with COVID, and we suddenly found these new audit COVID questionnaires, it's more than possible that there could be a new audit questionnaire or some kind of disclosure that auditors require boards to make as part of the audit process. And so one of the other things that we've been doing at Limestone is also trying to keep the auditor for our particular products up to speed with where we are and what we're doing, trying to pre-anticipate any issues or requests for updates that might come further down the road. And then I think with respect to investment committees or advisory committees I mentioned before, it's also important to get the actors, there could be advisory committees to an investment committee, or there could be material investors that are represented on those committees, and they really need to be brought up to speed specifically as to why new information is required or further specificities required within that process. So I think, and then obviously, ultimately that drives cost, and unfortunately regulation always has a cost tag with it. And so it's important that all of the actors, understand that that's where this new cost, such as it is coming from. So, and then lastly, one of the new things that I found interesting is the way that it's shaped the management company's business development team's decisions. So where they target potential new clients, and now they're really asking themselves, actually, is this a client that we can do given the new regulation and the new requirements? How do we price this in, and so on and so forth. So, and I think there'll be more of that to roll out as 2021 carries on.
Yes, yeah, indeed. Thank you, Antonia. So I think it's now for the questions for the audience. Let me check.
Thank you, Irina. Yeah, it has been very, very interesting discussion, particularly all those matters around the AIF, so third-party mancos. Some of those questions, of course, we have been receiving from audience, and one of the questions which is very often is if the investor is not really open for, if the fund is not really open for investors anymore, do they still need to update the prospectus or PPM? Any comments, any let's say reactions to that?
I can take this question if it's fine for Antonia and Marco.
Sure.
I think it still remains slightly open. I mean, question on the industry, but at least my understanding and from the majority of the industry, it seems that whenever the sub-fund is closed for subscriptions to investors and the investment period is also closed, it's not necessary to provide, let's say, the disclosures in pre-contractual documents, because the fund as such is and the documents are not considered. There is no distribution anymore, and the documents are not considered as pre-contractual. This is also an opinion from the CSSF, what I heard yesterday, that they share this view, at least for the time being. There might be some clarifications from the EU level, but for the time being, those closed-ended funds with a closed subscription periods and investments, they don't need to amend their pre-contractual documents.
Right. Okay, one more question is about the non-EU AIF and which are under the NPPR. How would the Sustainable Finance Disclosure Regulation will be effective to them? So, Thomas, I think you mentioned that you work with quite some non-EU AIFs also.
Yeah, I mean, I think it really comes back to, and I guess this is the same comment with respect to the previous question. I think we also have to recognise that there are investors in the fund, and those investors will drive some of these things. So even if technically the manager distributor doesn't have to do it or isn't required to do it, investor sentiment, if it demands it, you will still need to do it. So I gave you the example of the insurance company that basically required so many disclosures and some new reporting to guarantee a 3-year lock-in of 100 million euro, which is clearly very significant to a medium-sized manager and the future of their business, especially after the year that we've just had. Then you're going to have to take that into account. So I think the message that we're giving to the non-EU based managers, and it doesn't really matter what sector they're in, is just because in your home market this isn't required, you created this fund in Luxembourg to be distributed within Europe to raise European investor money. And therefore you're going to have to ensure certain disclosures that you wouldn't necessarily do in your home market. And sometimes that creates a conflict because they don't want certain things to be disclosed and they're not required to, or they don't. If you take Singapore, you could be a real estate manager and not be regulated, but clearly that's a problem from an EU point of view if you're delegating the PM function. So there are certain things there we have to sort of take into account and make sure that there's a compromise that's found, which can either be expanded as guidance becomes clearer, because at the end of the day, you don't want to have an investor say, look, if you don't give me what I'm asking for, I won't invest my money.
Yeah. Right. How far the AIF should be involved in the review of documents such as the remuneration policy or the delegated portfolio or remuneration policy of the delegated portfolio manager?
The AIFM has an obligation during its initial and then ongoing due diligence to assess that delegated portfolio managers comply with the applicable regulation. Therefore, with this new piece of regulation coming in, it will be the obligation also of the AIFM to ensure that the delegated portfolio manager has correctly updated its remuneration policy or any other procedure at their level within the deadline.
Right. Though our discussion is for the time being, of course, concentrated very much on Articles 6, 8, and 9, particularly for AIFs, there's supposed to be a relationship between Article 4, also 4.1a. How the disclosures would work in that case? And are you already looking at them now, or that's something you will look at in 12 months?
We have already looked at them now because anyway there's a need to issue themselves within March the 10th on either applying it or not, and then there's more time to assess and analyze and disclose. In our case, according to the regulation, we're out for the time being, given the sites, less than 500 employees, but it's something which might evolve very quickly at group level, and therefore we are working with our advisors in the implementation also of Article 4.
Okay.
Yeah. I mean, I was mentioning before that we have an ESG client, and they've actually done those disclosures. So that's at least 4 of those additional 6 pages that have been added to the PPM. Now, the challenge now then is also for the AIFM to ensure that those disclosures are correct and they are monitored and they are checked on the right frequent basis.
Right. Okay, last question maybe around the timeline. Of course, we heard this morning also from a couple of other colleagues that, well, 10th March is going to remain. There is no consideration being made at present around postponing that deadline. Any visibility or any discussions around the RTS to be published and, of course, the deadline? Any information around that?
Not really.
Go ahead.
May rely on what has already been said in the previous panels. For sure, I don't expect that even if published between today and March 10th, they will be fully considered for this first round, first implementation deadline. But rather for a second step, it's anyway a more complex process, the entire implementation of SFDR, but also the other pieces of legislation like taxonomy, etc. So let's start focusing on this first deadline, and then we'll continuously work on the upcoming ones.
Right. Okay. Well, so the deadlines are going to stay as they are. Only option is to be ready and prepared, right? So, okay. Well, thank you very much, Marco, Thomas, Irina. It was a very interesting discussion, and I'm sure our audience, particularly representing the third-party mancos, have found this discussion very useful. Now, we conclude this session as well this morning. Since this morning we looked at first session with RN, second session with Linklaters, and third session with GSK. We looked at various, let's say, elements of SFDR, not only around the deadlines, but the nitty-gritty details around also the differentiation between the articles 6, 7, 6, 8, and 9, the exclusions and all that. Still, some elements remain where we couldn't have, due to the time limitations, the detailed discussions around, such as the exclusions, such as the relationship between taxonomy and SFDR. We also need to see further about the Brexit element, which we quickly discussed in the last panel. But yes, I mentioned this all for the reason that yes, there are quite some, let's say, unknowns and clarity required, which as LuxFLAG we would be certainly discussing with the market and making wherever possible available the descriptions through our next webinars or any type of, let's say, associate membership dialogue as such, right? So towards that end, I thank you all the speakers, Marco, Thomas, Irina. I thank the audience also. We would, at LuxFLAG side, we would keep continuing this dialogue with the industry and with the members around this SFDR topic, but of course, in general, around sustainable finance as such. We have just recently launched also our website, new website, LuxFLAGevents.lu, where you would see all those events which we'll be organizing, particularly now these days, of course, through electronically or digitally, but wherever possible also physically. So please do keep informed yourself through LuxFLAGevents.lu. Do subscribe to our newsletter so you will also receive information on the developments happening in LuxFLAG. For those which are labeled funds with LuxFLAG, of course, you will be kept informed on the approach of SFDR, LuxFLAG's approach of SFDR and the potential criteria change and reporting which will be required. So you will receive that all by email, but also in due time on LuxFLAG website. So towards that end, as we did for last 15 years, we'll continue developing and encouraging this dialogue and sharing expertise with the market on sustainable finance. And of course, that is all possible only with the help of associate members like yourself. So thank you very much. Thank you, audience, and I wish you all a very nice day. And certainly LuxFLAG remains at your disposal. Thank you very much.
Thank you. Have a nice day, everyone.